personal tax. So obviously we're coming to the end of the 5th of April for your personal tax returns. Just a few things to think of here to try and reduce your personal tax bill. So if you're earning between 100 and 125,000, the effective rate of tax in this band is about 65%. Because you lose your personal allowance, you lose £1 for every £2 you earn. And therefore, you can potentially transfer some of your, between husband and wife, you can transfer some of your allowances to increase the amount of allowances the higher earner will receive. Again, please speak to us if you're not sure how that works. Salary versus benefit. So again, this could be a really good way of saving some tax. So this is more relevant for the higher earners out there. But what you can do, if you're employed and you, let's say you earn 100,000 a year, and it's coming to March, and you're due a big pay slip or you're due a bonus, you could potentially ask your employer to, instead of paying that bonus to you as additional income, whether they would pay that direct into a pension. And what that will mean is, instead of obviously you being taxed PAYE and national insurance, that will go straight into your pension. And therefore, if your income was going to go, say, from 100 to 110,000, and you would be taxed at roughly 65%, your income will stay at 100,000, and you'll also get tax relief on the money going into the pension. And lastly, inheritance tax we're going to touch on also today. But this requires some careful planning in looking at your estate and wills and trusts. So again, we'll touch on that shortly. So inheritance tax, here we go. So yeah, the number of families affected by inheritance tax is increasing greatly, even though the government have increased effectively the tax-free band up to £1 million for husband and wife. With the value of properties increasing so much over the last 10 to 20 years, a lot of people, that £1 million is taken up, the vast majority, by their residential home, and therefore any other assets they're leaving will be taxed at 40%. So just a few points to touch on. So charitable gifts, so you can leave up to 10% of your net estate to a charity, and that reduces the rate to 36% rather than 40%. Gifts to family and friends. So if you're looking ahead and you're of the older generation, if you make gifts and you live at least 7 years, then those gifts are passed out of your estate. If you die within the 7 years, depending on how far has gone, that relief is tapered off. But again, this is something you should definitely start looking at. Passing on your pension. So please, you need to make sure you've updated your will, the full, so who your pension goes to. One thing to touch on is that if you die before you're 75, your pension passes on tax-free. And if you pass away after 75, the beneficiaries will pay tax at the marginal rate. And therefore, really, if you do not need to touch your pension and you have other assets or other income, you should touch that first and leave the pension till last until you really need to touch it. And trusts, again, there's a number of ways to gift assets into trusts. This is especially relevant for investment businesses. And therefore, again, please speak to your financial advisor to discuss any trust that you might want to bring into play. Personal tax allowances. So there's two main allowances. Obviously, we know you get your £12,500 a year for earned income, which hopefully won't get attacked in the budget, but the government, I think they're going to keep that £12,500. You also get a lifetime allowance for pensions, which is currently just over £1 million. And once you hit that lifetime allowance, you really need to be careful, because effectively you start getting taxed on top of putting money into your pension. In terms of how much you can put into your pension each year, so you can, at the moment, you can put in £40,000 a year tax-free into your pension. Now, from 2021 tax year, if your income goes over 240,000, that 40,000 is tapered down to a minimum of £4,000 if your income is over 312,000. However, you can use 3 years brought forward annual allowances. So if for the previous years you've been earning, let's say 100,000, and you have a 40,000 annual allowance, or sorry, annual pension tax-free allowance, you can use that and make a large contribution in the next year. So just some more points on pensions. When you hit 55, you can draw down 25% of your pension tax-free. Again, depending what other income and assets, you might think, actually, I want to leave that because I don't need that money right now. And as I said, later down in life, that might be outside of your estate in terms of inheritance tax. Pension contributions made to employees by an employer are tax-free. So you can also claim business tax reduction against that. And also, all children can also have a junior pension and make up to £2,880 per year, which then gets topped up by an extra 40% on top, 20 to 40% on top of that. So you can start a junior pension for your child from birth, and this could be a really good tax efficient way of saving for their future. So just a few tax efficient investments for you to look at. I think most people know of an ISA, and you can have £20,000 paid into an ISA a year, and any gains or interest earned in your ISA is tax free. So you can look at things like the Help to Buy ISA, the Stocks and Shares ISA, and also the Child's ISA. So you could potentially for your children have a junior pension and a Child's ISA, which is two really good tax efficient ways to start saving for their future. But there's also other things to look at. So whether you want to look at any investments, so from an EIS and SEIS perspective, and if you do make investments into these types of schemes, you can potentially get between 30 and 50% of tax relief on those investments. So if you want to try and reduce your tax bill and you're also looking to make investments into these types of businesses, again, please speak to your advisor and they can go through that with you further. And there's also just a few other different types of investments there, like venture capital trusts and life assurance bonds. Just a reminder, if you are planning on investing on any of those schemes, please do make sure that you speak to an independent financial advisor along with getting the tax relief, because you want to make sure you're putting your money in the right place and also where you're putting it is going to work for you.